You finish your 9 to 5, clock out, and switch gears. Whether designing logos, driving for Uber, or selling crafts, you're officially earning money on the side. When those first e-transfers hit your account, it feels like pure bonus cash. You see $100 come in, and you assume you have exactly $100 to spend. But the Canada Revenue Agency sees it differently. The moment you earn a single dollar outside of a traditional employment contract, you are legally classified as a sole proprietor, a self-employed business owner. Spending that gig money like it's a tax-free bonus creates a massive invisible debt with every single client payment. It's waiting to catch you completely off guard when April tax season rolls around. This chart shows a standard paycheck. Your employer automatically chops off income taxes, CPP, and employment insurance. But as a sole proprietor, that shield is gone. You receive your gross revenue fully unprotected, making you entirely responsible for remitting your own taxes. Taking the financial habits you learned as an employee and applying them to a freelancer's tax burden is a guaranteed way to spend money that legally belongs to the government. Your absolute first line of defense is isolation. Open a dedicated, separate bank account. A free personal checking account works perfectly, and route every single business transaction through it. Keep your gig income cleanly separated from your grocery money. Come tax season, the CRA combines your side hustle earnings and your day job salary on the exact same personal tax return. Looking at this bar chart of tax brackets, you can see how tax stacking works. Your full-time salary fills up the lower, cheaper tax brackets first. Your new gig income sits directly on top of that base, meaning every side hustle dollar is taxed at your highest applicable marginal rate. Your employer is withholding taxes based only on your salary. Because your extra gig income is hit at your peak tax rate, your side hustle will always feel significantly less profitable per hour than your day job. And then comes the Canada Pension Plan. At a traditional job, you pay half of your CPP contribution, and your employer pays the other half. As a freelancer, you are both the employee and the employer. The CRA requires you to cover both halves of the contribution yourself. This pie chart visualizes that requirement. It creates a combined hit of 11.9% on your net self-employment earnings, and that is before income taxes are even factored in. That mandatory double contribution acts as a heavy secondary tax. If you haven't budgeted for it, that nearly 12% surcharge will completely wipe out your profit margin. As your business grows, you hit the first tripwire. If you end up owing more than $3,000 in net tax for the year, the CRA requires you to start paying quarterly tax installments every March, June, September, and December. Missing those mandatory quarterly payments triggers steep penalties, with the CRA applying compound daily interest on whatever you owe. The second tripwire hits when you bring in $30,000 in total revenue, not profit, but gross sales, over any 4 consecutive calendar quarters. The moment you cross that threshold, you are legally required to immediately register for a GST or HST account and begin charging sales tax on your client invoices. Scaling a side hustle introduces new operational realities. Pushing your revenue higher automatically pulls you into new mandatory legal compliance frameworks. Let's add up that true overhead. You're paying your highest stacked marginal income tax, an 11.9% double CPP contribution, plus all of your unreimbursed personal business expenses. The most expensive mistake new freelancers make is looking at what they earned per hour at a day job and applying that exact same rate to their gig work. Because you are shouldering all the taxes, pension contributions, and operational costs yourself, charging an employee rate ensures you will actually take home significantly less than minimum wage. This formula is the mathematical solution. To offset the heavy burdens of a sole proprietorship, you have to use the freelance multiplier, taking your base hourly rate and multiplying it by 1.5 to 2. If an equivalent full-time job pays $35 an hour, your absolute minimum freelance rate must be between $53 and $70 an hour. To secure your financial safety, start by hoarding 30% of all gig revenue immediately for taxes. Then you must strictly track all deductible expenses, like your home office space and software subscriptions, to effectively lower your total taxable income. You are operating a legal business entity. Aggressively pricing services to reflect that reality and anticipating taxes before they are due is the only way a